Hey, founders, hope you're having a good day, a good week. This week, I had the opportunity to talk to one of my clients, Nick, and Nick is working on a media-based startup. We had done some work together trying to get him investor ready. He's at the point he needs to raise some outside capital. He's been able to fund the startup so far and accomplish a few milestones, but he needs to raise that outside capital in order to scale the business. The type business he is in takes a lot of capital because it's based around media and content. And so we talked about the idea of how to value his startup so that when he goes to talk to these investors, he has an idea how much money already have an idea how much money he's going to ask to raise, but he wanted to understand how much equity he may have to give up in exchange for that capital. So we got to talking about startup valuations. Now, Nick's business is a pre-revenue startup. And so valuing pre-revenue startups is very different than regular companies. So we're going to talk about a few of those things today. So very first thing to talk about, why does a startup valuation matter? Well, as I mentioned or alluded to, your valuation helps determine the amount of equity you're going to have to give up in exchange for the capital that you're raising. So a good example is if you've watched Shark Tank at all, you've seen this exchange where the founder comes in and they say, hey, my name is Jonathan, my startup is XYZ, and I'm raising $100,000 in exchange for 10% of my company. So what does that mean? Well, what that means is they have valued their company at $1 million. The way that works is you take the amount of equity that you are raising and you divide that by the equity that you're willing to give up. So in this case, it will be 100,000 divided by 0.1 or divided by 10%. However you feel comfortable plugging that into a calculator. That gets us to a $1 million valuation. With a startup valuation, the challenge is twofold. So for Nick, what we talked about is the idea of giving up too much equity in his business. Let's say an investor wanted 50% of his business. That leaves less equity that he can use in later rounds of funding. And almost every startup out there tends to need more than just one round of funding. That's why you have Series A, Series B, Series C, Series D. If you look at companies that make it all the way to IPO, a lot of times those have raised as far as Series E and onward. I've seen a Series G company that has received Series G funding go public through an IPO, an initial public offering. So the amount of equity that you give up, it has challenges, because if you give up too much as a founder, you're losing some of the equity that you could have in the business, but you're also losing additional or equity that you could use in additional rounds to give to new investors and key employees. Now, the flip side of the challenge with the startup valuation and why it matters is that if you aren't willing to give up enough, you're going to have a hard time attracting an investor. So Nick and I will sort of walk through how this is going to work for him and the challenges that he's going to have. So the reason valuing a pre-revenue startup is so difficult is because you don't have any milestones to go off of. Okay. And so when you value an existing business, a traditional business versus a pre-revenue business, there are more things to use to make that valuation off of. So a normal company that has been in business for a while and has revenue has some milestones or some historical figures that can be used to get that valuation. So as an example, a traditional business, let's say you own, I don't know, a business that manufactures widgets, and that business has been around for 10 years. In a traditional business like that has existing historical figures for revenue, the way a business appraiser would value that business is they would first of all take the net revenue that that company or that business is making, and then there are some things that you can add back along the way. There are things like depreciation, interest, discretionary spending through marketing. That's not what this video is about, but just know that there are things that can be added back to get to a true net revenue number. Then they use a multiplier of that net revenue to figure out the value of the cash flow off that business. If you're in the restaurant industry, that multiplier is a little bit lower because it's not as much in demand and there's fluctuations and seasonality and things like that. You might get 2 or 3 times your net revenue. If you're in a software company, you may get 5, 10, or higher times your revenue. So let's say that you have a business and the net revenue after all your add backs and discretionary spending is $100,000. In a restaurant industry, you might get a valuation for that cash flow of $200,000 to $300,000. If you're a software company, that could be upwards of $1 million. And really what we're saying with that multiplier is that the buyer is buying X number of years of anticipated cash flow. Okay, so that's really what that means. So we take the net revenue, we add a multiplier, and that gets to the value of the cash flow off a traditional business. We also then take the value of any assets that will be transferring to the buyer of that business. So if you have real estate that's going to transfer, equipment, those types of things, all this is kind of pulled together and added to get a value for this revenue producing business. So you can see almost all of those things are missing in a pre-revenue company. So that's what makes it so difficult and why it's so different to value a pre-revenue business versus a business that has been around for a while or a traditional business. Now, the good news is that there are ways to value a pre-revenue business. And so I'm going to run you through a couple of things that you can use to establish the value of what you're doing. So the first one is going to be traction, and traction or milestones can be things like early number of users. Let's say you've hit 1,000 users. Let's say you've had your first beta customer come in, you built your software, you built your solution, you built your prototype, you've had your first actual user get their hands on that solution and they've been playing with it. First customer, first paying customer. Now notice I'm talking about a pre-revenue startup and I'm saying first paying customer. Just because you have a paying customer doesn't mean you're making any money, right? So first paying customer can be traction. Proof that your marketing is working. So let's say you've been running marketing campaigns and you have some historical figures off of those campaigns. Let's say you've used that and you've been able to establish a very strong CAC, customer acquisition costs. If you have that, investors will put some value on that because they know if they pour money in, you can use that money to attract so many new users or customers. Another factor that you can look at for traction is just your growth rate. Let's say that you're growing 10% month over month. That's traction that an investor can put some sort of value on. Another thing that investors put value on is the founders themselves. If you've studied the startup industry and you follow some of the well-known names out there, the Elon Musks of the world, Jack Dorsey, folks like that, anytime they start a brand new business, they have no trouble raising money. And that's because they've had successful exits in the past. So founders' experience goes a long way toward adding value to a startup, a pre-revenue startup. If you have never had a startup successfully exit or accomplish some really good things, return some investor money, those types of things, then there's not much value in that as a founder. Another factor that can be used to establish some value, I mentioned the word earlier, is going to be an early prototype. So maybe you have a mock-up of your software. Maybe you have an actual physical prototype that investors can put their hands on and play with. That adds some value to the pre-revenue startup. Intellectual property is another thing that adds some value to your startup, even if you don't have revenue yet. Now, when I talk about intellectual property, I'm not talking about copyrights or trademarks. Those are not near as valuable as patents are. And when I talk about patents, we want to focus on issued patents. If you have a pending patent, that doesn't mean a lot. Some people get hung up on this, but so I'll touch on it for just a second. Anyone, you, me, anyone right now could have a pending patent. All we have to do is go on and file for that patent. So pending doesn't mean anything. You need an issued patent with the patent number. That will add value to your pre-revenue startup. Historical figures are a great way to value a startup. So Nick and I talked about the idea of researching other media companies that have raised an early round and what was their valuation at that time. And he can use those historical figures to get an idea of what he thinks. Nick can use historical figures for other startups that have raised money in his industry to understand what amount of equity he may have to give up for a seed round. Historical figures also matter because you can just use that as a basis for establishing a valuation. What I mean by that is normally in a seed round for a pre-revenue startup, normally what you can anticipate giving up in equity to investors is somewhere between 15 and 25%. The more traction or milestones that you have accomplished, the less equity you'll have to give up. You'll be on that lower end, that 15%. If you have not accomplished as many things and you're kind of just sitting in an idea only stage, you may be able to find an investor they're probably going to want upwards of 20, 25, and sometimes even more percent of your startup. So historical figures are a great way to do it. The last idea is using a traditional startup method. And I'm going to run you through this verbally. I'll also try and put it in the description so that you can have it in writing. Bill Salmon is a Harvard professor, and he had a method for valuing pre-revenue startups. And the way it worked was anticipated exit amount. Okay, so let's say that you redo your research and other media startups have exited at $10 million. Anticipated exit amount divided by the target ROI factor. So if you think that you're going to make your investors 25%, this would be $10 million divided by 20%. That gets you to what they would call a post-money valuation. You then take that post-money valuation, you subtract out the amount that you're raising right now. In Nick's case, it would be, let's just use the number, it's a little bit north of this, but let's say $500,000. So it would be the post-money valuation minus the seed round, which is $500,000. And that gets you to a pre-money valuation before dilution. You finally take that number and multiply it times the anticipated ownership dilution, and that gets you to a pre-money valuation. That's a little complex, but I wanted to share with you that there are ways to do that and are methods that you can use to calculate a valuation. The truth is that getting to a valuation, particularly in a seed round in a pre-revenue company, is all about negotiation. Since there are less things to base the valuation on, it really comes down to what the investor is willing to give you in exchange for what you're willing to give up in equity. There are some alternatives to doing this. You don't even have to put a valuation on your pre-revenue company. You can use things like convertible notes, safe agreements from Y Combinator, which is simple agreement for future equity. I'll point to my video on that in the notes. You can use those type of instruments that are called convertible notes, and they punt or push the valuation to a later date when you have more information to be able to come up with a really good valuation. Till next time, I hope that helps, and I hope you find your voice. Hey guys, one more thing before I let you go. If you're a startup founder and then you believe you're going to need to raise capital to grow your business, then I recommend you check out my course, The Startup Funding Formula. In that course, I run you through everything I've learned in almost $500 million of transactions working with entrepreneurs to raise capital. We talk about what investors are looking for, what documents you're going to need, and more in the course. And just for being a subscriber to my YouTube channel, if you'll enter the code QUARTER, QUARTER, you'll get 25% off at checkout.